Hello there. Thank you for purchasing the private lesson series. We're going to go over my entire strategy over the next 6 hours of content. And hopefully by the end of this information, you will be completely independent in your ability to trade. And with what you have learned, I do hope to make you a profitable trader. Now, I'd like to start off by saying that there is a huge hole in the typical retail understanding of technical analysis. And that is a majority of the information peddled to you, whether it's through trading websites or whatever other course you've heard of. Most of the information, most of the indicators, is derivative information. Rather, it's not the source of the move, but merely reading the results of the move. And one of the biggest problems of that is you aren't getting the source of the information. So think about this. Would you rather bet on where a whale is going to jump based on where the waves were or based on where it's breaking out of the water? Right? A majority of technical analysis is laggy. A lot of lagging indicators. You're getting old results, old news, and typically in default setting indicators as well, right? If you're using a MACD, a moving average convergence divergence, all you're doing is looking at how close or far away two moving averages are. And the unfortunate bit about that is you are watching the waves, not the whales. So, I am very fond of leading indicators and volatility, and you're going to hear all about that. So, I would like to mention there's only one thing I use when I trade. Bollinger Bands. This chart layout I'm currently showing you may look a little complicated, a little intimidating, but there's only a few things here. This is a Bollinger Band. This is the CCI, which is simply a mean absolute deviation representation of a Bollinger Band, and the wave PM, which is a representation of the expansion and compression of a Bollinger Band. There's nothing else on my chart. It is much better to be very, very skilled at using one specific tool than having a vague understanding of a vast number of tools. One of the most common mistakes I see beginning retail investors make is having a chart that is absolutely filled to the brim with 14, 15 plus indicators, all telling them different things. You should have your strategy operating in a vacuum. And what I mean by that is everything should be selected and carefully distributed on your chart to get the best readings possible. Now, I do have someone tuning in with me today, and it's actually his private lesson that you are going to watch here. Go ahead and introduce yourself, my friend.
Howdy, my name is Bianco. I'm from South Africa. I'm learning to trade.
Beautiful. And everyone else watching this is learning to trade too. So, let's talk about this. If everyone uses the same information, are they likely all going to be correct? Not particularly, right?
No.
Let's load up a basic default indicator on our chart and watch what happens. Let's load up RSI, okay? Now, I'm not particularly against RSI for any specific reason, other than the fact that it doesn't fit into any systems particularly well. What you are trying to do when you're charting is create a system of information, something that is comprehensive and everything complements each other. If I go ahead and ask a trader, why their indicator works, they will typically result to one of three things. It's a proven standard. This is a problem because that is an appeal to authority fallacy. Somebody told you that it works and you trust them. Unfortunately, trusting other people when it comes to trading is a bad idea, since it's most likely that someone is trying to get you to do something to act in their best interest. Next up is, it's the golden standard of technical analysis. Everybody uses it. The problem with using something that everyone else uses is that 95% of traders lose. And I suppose you could go on to say, well, I guess I just have to learn how to use it better than everyone else. But why would you want to learn how to dig with a broken shovel? Sure, you can outdig some other people with your bare hands, but wouldn't you prefer to have the proper tool set to succeed, so that when you finally do develop the proper skill set, you'll be better off when it finally comes down to digging your hole, or hopefully digging yourself out of a hole if you've lost money so far. So, one important note is, a lot of people like to sit on the lower time frames. It's very, very satisfying to sit on the 5-minute chart with some default information, like our default setting RSI, and simply take signals that we see, right? And let's take a look at this particular section of a new uptrend on Bitcoin, okay? Do you see this price action happening right here?
The first spike.
Yeah, the first spike. And excuse my brush tool, he's being a little finicky. Right, this first spike right here. And over here on the RSI, we are seeing a large spike of information. It maxes out on the RSI. We get all the way up to around 80. That's pretty high for the RSI. Now, is this a short signal because it's overbought? Absolutely not.
No, the trend only started.
Yep, because you are just starting a new trend. And one of the most important parts of trading is trend identification. Overbought and oversold aren't real. They don't exist. That's true because outlier conditions aren't signals. They are conditions. So the difference between a condition and a signal is very important. Market condition represents how signals will be interpreted, right? This RSI right here, rolling down, that's a signal. But it doesn't account for the condition of the market. And when we talk about condition, there are two states, and they are going to be relative to the time frame you're looking at. There is trending and not trending. And that's as simple as it is. So if we pop ourselves over to Bitcoin's daily chart, let's talk about how we're actually going to define trending and not trending. Vian, go ahead and tell me what a Bollinger Band is. What do you think it represents?
So from my understanding, it represents the how do you say it? The movement of the data within a specific range. Okay,
the movement of price in a specific range. That's fair enough, and it is partially true. What a Bollinger Band is a representation of a bell curve, okay? And I hope you are familiar with a bell curve. If you aren't, just go ahead and pause the video and look it up, right? A bell curve represents how much data is in a distribution. A distribution is a set of data, okay?
All right.
And Bollinger Bands are typically used to represent a certain amount of data inside of a distribution. So if we have 0, okay, what is 0 going to represent?
Basically the middle of the bell curve, the average of the data.
Perfect. Yep, the center, the mean.
Yes, yes, the mean.
Beautiful. And the first standard deviation, right? There's going to be a positive first standard deviation and a negative first standard deviation. That's going to represent 68% of the data. Okay? So in between the -1 and the 1, we would anticipate 68% of the data to reside between these two values.
So the price would move between 1 and 0, 168% of the time.
Or rather, 68% of points or values will reside between
that range.
Right, for that period. And that's very important. The length of the distribution, how much data you're measuring. If I have 200 kids and I'm measuring their height, and we have a student who is 7 feet tall, is he going to move the average all that much?
No, not
Okay.
one.
And what if we had 10 kids and we had a student who was 7 feet tall?
Should be able to move the data about 5%, I think.
Yeah, the band,
correct?
it would change the average of the data much more rapidly than a longer set of data. The more data points you have, the less reactive the mean will be. Now, the mean will always follow the newest points of data, right? Because let's say we keep on adding 7 foot tall students, right? Well, the average is slowly going to move towards 7 feet.
Exactly.
So, I did not mean to do that. Perfect. And for the sake of clarity, we are going to talk about the second standard deviation, which is another very important data point. And it's actually the default setting of the Bollinger Band. Okay? And over here, we're going to have -2. So, I'm going to load up the settings of this Bollinger Band and do the following. I'm going to keep its length at 200, and I'm going to change it to the first standard deviation. For the previous 200 candles, how much data should the first standard deviation contain? And we can count back 200 candles, okay? So if we look back 200 candles, or bars if you will, right? That is 200 bars. How much data should these Bollinger Bands contain?
68%.
68%. Okay, now I'm going to load up another Bollinger Band. This one is also going to be the previous 200 candles, and this one's going to be the second standard deviation. Okay, this should contain 95% of the candles. And we can keep on doing this. We can go all the way up to, I don't know, the fifth for 99.9999% of the data, right? However, there is a very, very big flaw in the way Bollinger Bands are used and explained for retail investors. And I'm going to change a Bollinger Band to its default settings here, okay?
Okay.
This is nice. This is what people use to trade. All right, for the previous 20 candles, right, since we changed our period to 20, it should contain 95% of the points of data. However, this is kind of a problem, since it assumes you do not add any new points of data, right? Think about this. If I look back 20 candles, right there, beautiful. This little section is going to contain 95% of the data, and it does. Look how perfect that is. About 95% of all the candles are inside this band, inside the second standard deviation. So, does that mean you should buy when it's no longer inside, right? Since think about this. Oh, if 95% of the points of data need to be inside the band, then this means it needs to go back towards the center of data. Yep, that's unfortunately flawed logic.
But it can also be trending starting.
Say that again?
The other thing that can happen there is trending can actually start, and then you are waiting to go to, you are trading the price to go back, or you're betting on the price to go back to the mean.
Yep. Let's take a look at this. That's very good, yeah. You would... lost my train of thought there. Fun. So, the mean is not the center of data. And that sounds very, very counterintuitive, but I'm going to get on it in a second, okay? I'm going to change this to the 200 band again, just so we get a little bit of a higher resolution on what's happening. So, I loaded up a 200 band and the second standard deviation, which is supposed to contain 95% of the data. So, if this is the center of the data, this little blue line down here, what's happening all throughout here? Why, for the previous 200 candles,
as the price not come even close to the mean.
And it's actually outside the second standard deviation consistently for most of the time. Now, if 95% of the data is supposed to be contained inside the second standard deviation, why does the majority of the candles occur outside the second standard deviation?
Consistent trending?
You are correct. And that is because the mean is the outlier.
Outlier.
The center of the data, while it represents the center of the data, is actually outlier information. Do you know when the last time Bitcoin hit the 200 moving average on the daily chart before 2018 was?
Let me see there. 1 second. When did it hit the 200 mean? Before.
And it's going to take a lot of scrolling, I'll tell you that.
Yeah, I can see that. Wow.
It was 2015. So.
Yes, there. 22nd of October.
Yes. Why was the center of data not touched for 3 years? It's because the mean is the outlier. The center of the data is not the center of the data. And we can see this on any long-term time frame, including the major indices. Let's look at the Dow Jones Industrial Average. And we're going to go to, well, the daily chart's just fine here as well. But let's actually go to the monthly. Okay?
So that's been an upward trend for years.
Let's look at 1995 to 2001. 95% of the data is supposed to be inside this band. But it's outside the second standard deviation for over 5 years. So, do you know what happened in the US in 2008?
The recession.
Mm-hmm. The housing market crash.
Yes.
And oh boy, it was a crash, right? If I recall correctly, we drew down 43%, 53%, excuse me. Now, where does price go to during this crash?
Reverts to the mean.
To the center of data. So, while the center of data...
Outlier.
Yeah, perfect. And what kind of event drives price to the center of data?
Maybe fear, uncertainty.
That was the
People don't
exact
wanna buy
wording.
people don't want to buy anymore. They're very uncertain, so the price then slowly moves back. It becomes more volatile.
Perfect. Yes, fear and uncertainty drive price towards the center of data. Now let's go ahead and take a look at BTC USD once more. And the monthly chart might be a bit concerning when I load this up. How's that for ridiculous? Whew. That is obscene. Certainly quite the crash pattern.
Yeah.
And let's go back to the daily chart here. Now, how do we know if we're actually trending or not? What's going to be the key signal for us to know if something has the alignment of expectations for growth? And I suppose that can be rhetorical for now, but I'll come back to it for you. I'm going to load up 2 more bands here, and I want you to tell me why I'm doing it. I'm loading up the 5th standard deviation. That should contain a ridiculous amount of data, right? It should essentially contain all the data. Now, this is another reason why you don't buy overbought, or you don't sell overbought and you don't buy oversold. Bitcoin on the daily chart was a 5th standard deviation event. That's above 99.9997%. Okay? So if you try to short every time you have an outlier, you're not going to be treated very well. However, if we can learn how to identify the one important thing, trending and not trending. So I'm going to load up 2 bands here. I loaded up the 5th standard deviation for a very specific reason. Why do you think I might have done it?
So that you have all the data points in the distribution. Covered in that band.
Okay. But does it really matter how much information is inside of a distribution? Right? Because with a high enough standard deviation, all the data will be inside the distribution.
Correct.
So, the reason I've loaded up the 5th standard deviation is to exaggerate its expansion and exaggerate its compression. And this is how we are actually going to define our 2 market conditions, trending and not trending. What do you think expansion means?
Upward trending.
Oh, it doesn't have to be upward trending. What's happening here?
Expanding again.
Yeah, it's expanding, but to the downside.
Yes. Like I said, doesn't mean a specific direction of trending.
Oh, no, absolutely not.
And expand.
As long as it's expanding, it's trending. And then you simply choose the direction on whether or not it's above the band or below the band.
Or below.
Right? Since if your bell curve is getting wider, that means data points are being consistently added in one direction. If you have a bell curve and it keeps on getting wider and wider and wider and wider, well, that means you can anticipate that taller kids are getting added to the classroom, as per our previous analogy, right?
So that's what basically happened all the way up on that chart.
Say that again?
That's what basically happened while the price went all the way up. The up curve expanded.
Yep.
It's more data points were added in one direction upwards.
Right. Continuous expansion is continuous trending. And we stopped expanding right there, right? On that blue line. That's where we stopped expanding.
When price moves back into the 200 containment zone.
Nice wording, yeah. When we move back inside this pivot, and we'll talk about that in a second. I just want to hammer this in one last time. If we are compressing, we are no longer trending. And if we are no longer trending, we are going to trade laterally. And that lateral trading will be defined by one very important thing. The 1.25 standard deviation. This is going to act as the pivot point for expansion and compression. This piece of data, the 1.25 standard deviation, is the empirical constant that defines a distribution's expansion or compression. And that should go in your notes.
Is that always just the 1.25 standard deviation?
Always the 1.25, right? Let's load up the second. It doesn't matter the period. I'm going to change this to a 100 period. And we're going to do the second standard deviation. And then I'm going to load up the 100 on the fifth as well. Okay. So let's take a look at this again. I've loaded up 100 previous candles, right? Now we're only measuring 100 previous candles. Is that going to be more reactive or less reactive than 200?
It should be more reactive.
Right, since it's going to take less data points to move the mean. So it starts compressing by looking at the fifth standard deviation right here. As long as we are outside the second standard deviation, does anything happen? Is it particularly important?
No.
Nope, doesn't really mean anything. And that's because the only pivot for expansion and compression of a distribution is the 1.25. If I change this to 1.25, you'll notice we start compressing as soon as we move inside the band. When we're inside the band, the 1.25 standard deviation band, then every other single standard deviation for this period will start to compress. So, how can we use this data?
So that'll tell you when the training starts or when training stops and when training starts. The pivot point, exactly.
Exactly. So all this is trend identification. As long as the bell curve gets larger, it will continue to get larger. But the moment it starts compressing, well, you're no longer trending. And that brings us to our two conditions of trending and not trending. Now, we are going to talk about, look at my notes here. Yes, the misunderstanding of overbought and oversold signals. Okay, and I'm going to load up a CCI. Okay, and I'm going to use a 200 period. Well, I'll use a 14 period. Well, I guess 100. We'll use 100. Okay. So, why do you think this recent move on Bitcoin was so oversold? It's at negative 500 on the 100 period CCI.
oversold.
Yep. On all the YouTube channels the last month, people have been talking about how oversold Bitcoin has been. But why is this particular reading so oversold? And what actually makes oversold?
Well, can it be because the price has moved far away from the mean? And so far away that it's outside the standard deviation.
Okay. The part about it being far away from the mean is incorrect, but the latter part is correct. Okay? So let's look at this signal right here, where it was overbought. Okay? In this overbought signal, from the location where it's not overbought to the most overbought section, that's from 100 to 350. If I drag up a ruler to see what percentage that is, that's 250%. Okay? And let's talk about that in terms of a drawdown as well. That's a 70% drawdown if it went the opposite direction. Now let's take a look at this signal over here. From the point where it starts to be oversold to the bottom of the oversold signal, that's only a 44% drawdown. So this signal has been much more drastic than this one. Or rather, the reading is more drastic, but the move is not. Why do you think this move was smaller despite being a larger reading? And I'll give you a hint. It has to do with the width of the distribution.
So basically because the bands are compressed, but with the second move, and now I've got an idea.
Alrighty. So because you have a very, very, very wide set of data, that means when price moves, it's going to be harder to push the indicator in that direction, right? Since if you have a very large and wide and spread out set of data, it's going to be harder to make it even wider. But if you have a very compressed set of data, like we did recently, in the most recent November, mid-November, right? That was a super compressed band right there. So if you add an outlier piece of data, what's going to happen to the entire distribution, the set of data? Right. It's going to be a more of an outlier event than something that was previously a larger move.
Does that make sense?
Yep. The tighter a distribution is, the easier it is to move. And now we're going to tie this into a physics analogy, okay?
All right.
Force equals mass times acceleration. Quite frequently, there is the most common aspect retail traders like to look at, momentum. Everybody loves momentum, or acceleration, excuse me. I'm going to use acceleration and momentum interchangeably right here. I know they're not the same thing, but this is an analogy, so bear with me. Momentum indicators are like RSI, right? You can tell how fast something is moving, or the direction of the trend, right? If it's a positive value RSI, it's an upward trend. If it's negative, it's a downward trend. And that's fine. It's an important metric. But what they fail to do is account for two other metrics, force and mass. What do you think force might be?
But yeah, I don't. With how much strength the price is moving up or down.
What drives the price movement?
buying and selling?
Yep, that's it. Volume. If somebody buys, they push price. They literally push the price upward. If somebody sells, they push the price downward. Buying and selling is force. Force in the market drives price. Now, the biggest and most important piece of all of this, and it's going to be the holy grail for the rest of the strategy, is mass. Mass is the most important and underused metric in all of the markets. And mass is going to be the width of a distribution. The wider a band, the wider a set of data, the more mass it has.
Okay.
The thinner a distribution, the less mass it has, right? And this brings us back into why this was particularly oversold. If we had a significant amount of force, but very, very little mass, is the acceleration going to be particularly high?
It'll be high, but not for long. Don't keep going.
Okay, if
So it might have a quick move and then slow down.
maybe, I would bet on that, literally. Think about this. If you are standing at the plate about to swing a baseball bat, and someone throws a baseball and you hit it, is it going to go particularly far? With enough force, of course.
Yes.
Yeah. Okay, now what if a bowling ball was thrown?
No, not that far.
Not that far at all.
Not that far at all.
It might just dribble forward. So
Yes.
mass, the more mass you have, the more force is going to be required to move it. Now,
Okay.
if you have little to no mass and you come in with a huge amount of force, you're going to hit it out of the park. And that's going to show up in the metric of overbought and oversold. Since the more force you apply to something with very little mass, it's going to be an explosive move. So, let's talk about this. If we have a particularly wide band, right, it's going to take an unrealistic amount of force to move price if you have an unrealistic amount of mass. So the longer and harder you push something in a certain direction, the more force is going to be required. The more buying or selling power will be required to push price in that direction.
Yes, like it keep going in the same direction.
Exactly. Think about it like this. What happens when you roll a snowball?
It accumulates more snow as you roll it up the hill.
It gets more and more snow on it. And the more you...
More mass.
Yeah, more mass.
You need more force to push it up.
Beautiful. And eventually you're going to hit critical mass, right? Where it would require too much force to continue moving it in that direction. So, what happens when it rolls down the hill?
It starts shedding its mass as it hits all the rocks and trees.
Beautiful. You've heard this analogy before. But for everyone else here.
That's the best one. That makes a lot of sense that way.
Beautiful. So the more mass something has, the harder it is to move. And that's why this move recently was so explosive. It's because we...
less mass.
Mm-hmm.
Because it has less mass.
Beautiful. That's perfectly correct. And that's why we had such euphoric price movement over here during Bitcoin's huge run. It's because we were able to constantly add more and more and more force with widespread international FOMO. Well, the number of people investing in Bitcoin over here was much lower than the number of people investing on Bitcoin over here. That's why we achieved a fifth standard deviation event. It's because we had unrealistic amount of force.
That's very interesting.
And that's why we can get such an explosive price movement over here, despite not having all that many buyers and sellers. Right? There are less people in the market now, but we can get more significant price movements because the distributions have shed their mass.
Nice.
Beautiful. All right, I hope I hammered that one in enough.
Yes, that makes sense.
Now, it's the amount of data contained in a Bollinger Band is really not that important at all. I do not care that this was a 5th standard deviation event. All I care about is this continued expanding for the entire duration of the move. In my notes here, I have line of ants analogy, and I have no idea what it means, so I'm just going to move on. Yes. Now, I do need to cover a few intensely important things, actually, about the use of TradingView, because these are mistakes I have frequently seen with my prior students. And the number one mistake I have ever seen is making your candles too small, right? If you compress everything all like this, can you tell if your band is expanding or contracting?
Not really, no.
Not really, no. You need to have a good grasp on your information, and you can't be all the way over here like this either, right? Never be too zoomed into your chart data. And this is actually a really bad habit to break, and there is an easy way to help that. If you open up the chart settings over here on TradingView, you want to set your top margin to 0 and your bottom margin to 0%. That's going to be under scales. What this will do...
0 and bottom margin 0.
Yep. This is really important, since it will actually snap the bottom and top of your data to be closer together. Okay? Now, for my actual default template, I do the following. Okay? I have a 200 band on the 1.25 standard deviation, and I have a 50 band on the 1.25 standard deviation. Now this is going to be really fun over here. Where do we stop expanding? Or rather, where does the 50 distribution stop expanding during this price movement here?
Stop expanding.
Yep. So all this information is going to be relative to the period. That's what makes this fun. Right? Since we're measuring 50 prior candles by just looking at this blue band. So when the 50 band re-enters the 1.25 standard deviation, what does that represent?
That's the end of trading, basically. The pivot for end of trading.
Yes, and it's very important we know that it stops expanding at that location, right? I just drew in my blue line there. I'm going to change this to, I don't know, the 7th standard deviation. And if we zoom all the way out, lo and behold, this is where we stopped expanding and started compressing. Okay? I'm going to change this back to the 1.25.
I see.
Right? So the period we're using doesn't matter. I can switch this over to a 90, well, let's do like a 400 period. Why not?
So it can basically be any length period.
Yes. The length does not matter because the pivot point of expansion and compression will match the period. So we actually stop expanding on this one at this location. Now, if we are compressing, we will trade laterally as defined by that period. So if we're outside a 400 band, we will trend as defined by the 400 band, specifically the 1.25 standard deviation. If we are inside the 400 1.25 standard deviation, we will trade laterally as defined by the boundaries of the 1.25 standard deviation. If we break outside, we will trend as defined by the 1.25 standard deviation of the 400 band. Now let's switch this back over to the 50 band. So this here, this price movement, as long as we're outside the 1.25 standard deviation of the 50 period, we are trending as defined by that period. When we return inside, we trade laterally as defined by that period. And when we break outside, we trend as defined by what was previously mentioned. And so on and so forth, forever and ever, on any period. I'll do the same with the 100. Right? Since we will stop trending faster on a 50 period, right? Because we stopped trending here. But on a 100 period, it will take us longer to stop trending. And then when we return inside the 100 band, we trade laterally as defined by the 100 period. So trend is relative. The expansion and compression is relative, as defined by the period you input into the distribution. The less candles you measure, well, the faster you'll stop trending and the faster you'll start trending. This is also, and think about this, if we have a shorter period, it will shed mass and gain mass much faster than a longer period.
Yes, much quicker.
Beautiful. We've got about 15 minutes left. That's pretty good. Or 20, I guess. I've lost track of time. And I won't really be on the nose with these anyway. And we can actually, let's look at the previous crash pattern for Bitcoin, shall we? And I'm going to load up another great tip for you guys. Load up BLX in your ticker and choose the first option. This will provide you with the full history of Bitcoin. And it is important to mention that this data will be true in any market type. I prefer to trade crypto because of its predictability, but you can use this in Forex and indices and securities as well. Change this to the 200 band. Okay. I also need to mention, really stress this, the importance of institutional benchmarks on the higher time frames. You should always have the 50 and 200 loaded up on the daily and weekly charts because they will be very well respected pivots for big players to buy and sell. So here we are. This is where the trend ends, right? Whenever we're inside this 200 band, the trend ends as defined by that 200 period. Then lateral trading as defined by the 200 band, right? All this is healthy compression, right? And that's actually true.
Mass is being shed.
Mass is being shed, that's correct. And as long as mass is being shed, it's healthy, it's normal. It needs to happen before you can move upward again. What is not healthy is downward expansion, which starts to happen at this location, right? Because now the 200 distribution is actually expanding to the downside. Downward expansion is downward trending. And downward trending, well, that should be pretty self-explanatory. This condition is down, right? It's a 47% drop. Now, as soon as we re-enter the 1.25 standard deviation, the band compresses, we shed our mass, and we trade laterally as defined.
So why did that not happen when we re-entered the band the first time? There where your mouse was just now.
Right here? Actually, that's a really good point. Think about this. From here to here, right?
Yes.
Rather, let's see how many candles this is. From this location to this location, right? 30 bars, 30 days, 1 month. You are technically not trending. You're going to get lateral trading as long as you're inside the band. And you do. And it only drops 6% for the duration.
So what should have happened is, as soon as the price went back, you should have basically, if you were in the short, you should have sold and waited.
Yes, though we have better ways to take profit, right? Expansion and compression is going to be conditions. And conditions provide the groundwork for signals. That's the important part. Since what we're looking at here, this expansion and compression is only outlining the conditions required for us to enter a position, but don't necessarily tell us to enter a position. So,
So it's like the first step.
Right. For this duration, it's a downward trend, and we'll use signals to enter and exit the downward trend. As soon as we're inside, we're going to get lateral trading, and we're going to change the signals and tools we use to trade a lateral trading. Then, as soon as we're outside, we get a trend, and we'll use signals to trade the trend. And this is what's so important about the conditions of trending and not trending, because we change our tool set to match the market condition.
Okay, that makes sense. A lot of sense.
Since if you know how to change a lateral range or trade a lateral range, do so to great success, as long as you know you're going to get a lateral range. If you know how to trade a trend, use the tools to trade a trend. And we are going to go over all the tools required to trade both conditions. And this is going to be true for any period, on any time frame. We can do this on the 1 minute chart if we wanted to quite some success. And I will save that for the 5th or 6th episode. And it might be a bit of humble bragging on the 1 minute chart, but you'll enjoy it.
Okay, great.
This is particularly nice as well, right? From here to here, we get trend. From here to here, we get lateral trading. I can keep on doing this. Might as well. Trend, lateral move. Oop, not what I wanted. Okay, we're done.
All right, so you first identify the condition. And then when you have the condition, then you start looking for signals.
Yes. First identify the condition, then you identify the signal to use the condition.
Okay, that makes sense.
Let's talk about the current move on Bitcoin. From here to here, we were going to expect lateral trading as defined by this period. And that's exactly what we got. As long as we compressed, we traded laterally, laterally, laterally. And all this was just healthy correction. And up until this point right here, it was perfectly reasonable to expect Bitcoin to expand upward again. That was in the cards, right? However, it just so happened that we did not get upward expansion. Instead, we got downward expansion. And because there was so little mass,
It's a very violent move.
it was a very large move because it required a very small amount of force to get the same results that we did all the way back here. Any questions so far?
Nothing yet.
Beautiful.
But that first run of Bitcoin, that was basically caused by the media. That's why, because the bands were expanded, so it took a lot of force to keep on moving that mass up the hill.
Yes, if you keep on adding force into the system.
And that was done by the media, putting news out for everybody to buy Bitcoin.
Absolutely.
And then so then it crashed. And then the second move didn't need that much media at all, because basically Bitcoin didn't have that much mass to move it significantly.
Beautiful. And
Very interesting.
super interesting, yeah. And
Yes, very interesting.
what's even better about this is that it makes trading the news obsolete, since I can tell you the news by looking at distributional mass.
Yes.
I know for a fact this is huge, immense FOMO because unrealistic amount of force is pushing price upward. But what happens as soon as the distribution starts compressing? That's the start of fear and panic. And when a distribution starts to compress after it has had too much mass, it's driven to the outlier of data, the mean.
Which is the mean.
We return to the center of data, and from the center of data, well, we have fear and uncertainty. Are you familiar with the indicator known as the VIX? Or rather, the VIX is a representation of fear and uncertainty. It is the volatility index, and it is typically used on the NASDAQ composite. And quite a few volatility traders use it. And there's actually a fix that allows you to use it on things other than the NASDAQ composite. Yeah, fear, gosh. I'm just looking for Williams VIX fix. See if that does it for me. Yeah, let's just load this, see what happens. Right, the VIX is going to be a representation of fear and uncertainty in the markets. Guess where fear and uncertainty is the highest?
Where price returns exactly to the mean.
The center of data. And do you know why fear and uncertainty is so high at this location?
No.
Because it's also the center of data. But not the center of data you are expecting. It's the center of data on the higher time frame. What is 200 times 7?
14.
Right. 7 days in a week. If we load up a 1400 moving average, guess where it's going to be? If I trace this line right here, and I go to the weekly chart, this 200 band is going to snap right there. So let's pop to the weekly chart and see what happens.
So, how did you get to that? Just go over that again, please.
Let's say that again.
Can you just do that again, please? How did you get to that average?
How did I get to that average? Yeah.
You took 200 times 7.
Yep.
Why did you do that?
Well, there are 7 days in a week, and I was looking at the daily 200 moving average. Right? 200 times 7 is 1400. So if I'm on the daily chart and I have a 1400 moving average, it's going to represent the 200 moving average on the weekly chart.
If you sorry, I couldn't hear what you said. You broke up there a bit.
Okay. If I have a 200 moving average on the weekly chart, and there are 7 days in a week, that means 200 times 7 on the daily is 1400.
1400. Okay, that makes sense.
And we can do this even more. If we have 6 4-hour periods in a day, what would the weekly 200 moving average be on the 4-hour chart?
If you had 6 4-hour periods in a day, What would that?
Right. If you have 6 4-hour periods on a day, what would the weekly 200 moving average be on the 4-hour chart?
That would the weekly 200 moving average be on the 4-hour chart.
Right. You would multiply 1400 by 6.
By 6, yes.
So that would be 8,400. If we actually load up the 4-hour chart and type in that value, it's going to be in the same location as the weekly 200 moving average. Pop down to the 4-hour here. Right? And I'm going to change this moving average.
So that's when you want to see the you want to see the larger time period average on a smaller time period chart.
Exactly. Right?
Yes.
So here on the 4-hour chart, we can see how price action interacted with the weekly 200 moving average. Even though we're on the 4-hour chart, we can still get the data from the higher time frames. And if you do this, you can get some really cool results on how it interacts.
Yeah, that's very helpful.
Right, since typically when we look on a higher time frame at institutional benchmarks, like, I don't know, over here, right? This is really nice where we get the 2 tests. What if we want to look at that in a lower time frame? This is the daily 200 moving average, right?
Okay.
So that would be 1200 on the 4-hour chart, if my math is correct. And then the weekly 50 on the 4-hour is going to be 2100.
Yeah, times 6.
Right. So if we were looking at the daily chart over there, and we snap back all the way over here to where I drew that red arrow, we can see how price action interacted on the daily 200 moving average on the 4-hour chart. And it can actually paint a much nicer picture. How it just wicks perfectly on those 2 instances. Of course, we can go lower and lower and lower to see how everything keeps on interacting. Though my original point for this was, change this back to 1400. The VIX, the representation of fear and uncertainty. We get the highest rating of fear and uncertainty when we return to a center of data.
So that's also why it's really important to look at the higher time frames, because if you only look at, you're on the daily chart now, then you would have not noticed that actually moves back to the center of data. So I don't know why that move went down to the spot.
Absolutely. And let's think about this. If we go to the weekly chart.
Look at the macro part of it.
Oh, yeah. I mean, we just have another instance of trending and not trending, but on the weekly. For the relative 200 band, as long as we are outside the 1.25 standard deviation, it is expanding. But what happens as soon as we return inside of the 1.25 standard deviation?
And we trade lateral on it into the mean.
We trade laterally as defined by that band. Obviously, we aren't going to go to negative 1,000, but and I'm very much enjoying my long positions right now on the weekly 200 moving average. Never underestimate the power of institutional benchmarks. Okay?
All right.
And recently, with how I've been trading this, there were some really nice signals on down here as well, right? Since I'm going to get a bit in my head of myself here, but I'm really having fun. What happens when we return inside of the band? The band compresses, and we trade laterally as defined by the band. Simple as that. So, get this. We were directly on top of an institutional benchmark, and we were compressing, which implied lateral trading. So, this is what is technically known as a dead cat bounce, where something has been going down, 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 down. The conditions change and allow for buying pressure to succeed. right? A lot of people were going to predict a dead cat bounce at this location. Why were they wrong?
Because the price didn't enter the band yet.
Yes. And as long as we are outside the 1.25 standard deviation, we are in the condition of trending. Beautiful. And as long as we are trending, well, don't bet against the trend. And that's why on one of my live streams recently, I was so excited with the following concept. Not trending. On December 10th, I labeled my live stream not trending. And that's exactly what happened. We were no longer in a downward trend. So we traded along the bottom edge of the band because we traded laterally as defined by the band before we returned to the center of data. And that's going to be true on every time frame as long as your distribution has significant mass. And to finish this video off, I'm going to go over a few final things on the terms of shortcuts. If you're curious how fast I'm navigating this chart, if you double-click the time scale on the bottom of the chart, you will automatically snap to the present moment. And if you are, compressed and all the way down here, and you want to snap back to what you're looking at, just double-click on the price scale on the right. That'll take you back to the center. I'm going to briefly touch on how I color pair my bands, since it's more of an opinion thing, but it's really important. I prefer to not have too many lines on my chart. Things get really messy if you do. So I'm going to load up a 50 band and a 200 band on here. This is clean and easy to read for me. I'm going to add a problem. Are you ready? I'm going to add the upper and lower edges to this and make them a visible color. This chart just got a lot harder to read. If you have too many actual lines on your chart, it's going to mess you up. So I highly recommend disabling upper and lower for at least one of your bands and relying exclusively on background color to get their transparency. And then if things are too hard to see, just drag the color slider on the right down as far as you like and have as little data on your chart as possible. That is so important, guys. My chart layouts are very clean and meticulous, and it's taken a long time to get them to this level of efficiency. So I very much recommend using clouds instead of lines. And my final important note here is in terms of money management. It is much more important to have a plan B than a good plan A. And having a good plan A and a plan B helps. But what I mean is, a lot of people have a plan A and they commit to it. They go in 25x, they're ready to leverage, they enter their long, and they shoot for the moon hoping to win. Always assume you're going to be wrong. Assume the worst case scenario and use your money management to properly trade it. Beautiful. And that just cuts us short on time, right on the nose. It's rather nice. And do you have any final questions for me?
None at this moment.
Beautiful. Well, I do appreciate what you guys have tuned in and what you've paid for. I hope it's all worth it for you. And with no further ado, I will see Vian next lesson, and I'll see you all in the next video. Thanks, everybody.
Thank you.